January 2021, you earned $50,000 per year. Your purchasing power index is set at 100. This is your baseline. Your paycheck buys a certain amount of goods and services. You feel financially stable. The economy seems fine. December 2022. Your nominal wage has increased to $53,500, a 7% raise. You should feel wealthier, but you don't, because the purchasing power index now stands at 93. Despite earning 7% more in dollars, you can actually buy 7% less than you could 2 years ago. Your wealth has been quietly destroyed by inflation outpacing wage growth. August 2024. The purchasing power index hits 89, marking an 11% cumulative decline from January 2021. You're now earning $55,000, a 10% nominal increase over 3 years. But you can afford 11% less than you could in 2021. Your real wealth has gone backward even as your paycheck went forward. This is how wealth gets destroyed before every major financial collapse. Not through dramatic market crashes that make headlines, not through bank failures that create panic, but through the silent, invisible erosion of purchasing power that happens so gradually that most people don't realize they're getting poorer until it's too late. Between November 2020 and September 2024, nominal wages in the United States increased 19.2% on aggregate. During the same period, consumer prices surged 20.6%. Wage growth was completely eroded by price increases, leaving real wages 1.1% lower than 4 years earlier. 4 years of working, getting raises, feeling like you're progressing, and you end up poorer than when you started. This isn't unique to recent years. This pattern precedes every major financial crisis. Let me show you exactly how this quiet destruction of wealth works, why it's invisible to most people until it's too late, and why understanding it now could save you from the collapse that's coming. The purchasing power illusion. Most people track their wealth wrong. They look at their salary, their bank account balance, their 401k statement, all measured in dollars. And when those numbers go up, they feel wealthier. This is the purchasing power illusion. And it's how wealth gets destroyed without anyone noticing. The formula for real wealth is simple. Nominal income divided by price level. If your income rises 10%, but prices rise 11%, you're poor. But the psychology works against you. The 10% income increase is visible, concrete, feels good. The 11% price increase is diffuse, gradual, doesn't feel like a loss. So you think you're getting ahead when you're actually falling behind. During 2022, inflation in the United States reached 8% annually, with June 2022 hitting a 40-year peak of 9.1%. Wage growth that year averaged about 5% to 6%. Every worker receiving raises felt they were progressing. But real wages were declining by 2% to 4%. Wealth was being destroyed across the entire working population, while everyone thought they were doing fine. The cumulative effect is devastating. Analysis using purchasing power calculations shows that from January 2021 to August 2024, the average American's purchasing power declined 11%. Not 11% in one dramatic crash, but 11% eroded gradually, month by month over 43 months. That's an average of 0.26% per month, small enough that you don't notice it monthly. Large enough that over 3 years it wipes out a decade of wage gains. For someone earning $50,000 in January 2021, an 11% decline in purchasing power is equivalent to losing $500 to $500 in annual income. But because your nominal wage probably increased during this period, you never felt that loss. The number on your paycheck went up. You just noticed that somehow money doesn't go as far. Your grocery bill is higher, gas costs more, rent increased. Insurance premiums rose, but you attribute these to individual price increases, not to systematic wealth destruction. This is how the quiet destruction works. It's invisible because the losses are distributed across thousands of prices, rather than concentrated in one dramatic event. Your wealth is being destroyed in ways that don't show up in your bank statement until you actually try to buy things and realize you can't afford what you used to. The period from 2021 through 2024 provides a perfect case study in how wealth gets destroyed before financial crises. We can track it month by month with precise data. And the pattern is identical to what happened before previous collapses. In 2021, wage growth accelerated as the economy reopened from COVID lockdowns. Nominal wages increased robustly. Workers felt confident. But inflation, which had been running at 1% to 2% for years, started climbing. By mid-2021, it reached 5%. By end of 2021, it was above 7%. The purchasing power erosion had begun, but most people didn't recognize it yet because nominal wages were also growing. 2022 brought the full impact. Inflation peaked at 9.1% in June, the highest in 40 years. Wage growth, while accelerating, never caught up. The biggest negative gap between wages and inflation occurred in June 2022, with wages growing 4.8% year over year, while inflation hit 9.1%, a 4.3 percentage point gap. For 25 consecutive months, from April 2021 to April 2023, average real hourly earnings declined year over year. Think about what that means. For over 2 years, every paycheck bought less than the same paycheck did a year earlier. Month after month, workers were getting poorer in real terms, even as they received nominal raises. The wealth destruction was systematic, relentless, and largely invisible because people anchor to nominal numbers, not real purchasing power. By December 2022, the cumulative purchasing power index had fallen to 93, a 7% decline in less than 2 years. Globally, real wage growth turned negative for the first time since records began in 2008. The International Labour Organization reported global monthly wages fell in real terms to 0.9% in the first half of 2022. When you exclude China, global real wage growth fell to 1.4%. This wasn't a localized US phenomenon. This was worldwide wealth destruction happening simultaneously. In 2023, inflation began moderating but remained elevated. Wage growth also slowed. The purchasing power index continued declining, reaching 91 by mid-2023. Despite inflation coming down from its peak, the cumulative erosion continued because wages weren't growing fast enough to recover the ground lost in 2021-2022. Only by late 2023 and into 2024 did wage growth finally begin outpacing inflation consistently. But by then, the damage was done. As of August 2024, the purchasing power index sat at 89, an 11% cumulative decline from January 2021. Even with wages finally growing faster than inflation, it would take years to recover the purchasing power lost during the 2021-2023 period. Research tracking the cumulative effect shows that purchasing power declined for about 2 years, reaching its low at the beginning of 2023, when lagged wage growth finally started to counterbalance the erosion caused by inflation. But the lag meant that by the time wages caught up, households had already been crushed by years of negative real income growth. The pattern of purchasing power destruction before financial crises isn't coincidence, it's mechanism. Understanding why this happens is critical to recognizing the warning signs. During economic expansions, central banks maintain low interest rates to encourage growth. Low rates make borrowing cheap, which stimulates spending and investment. This works well initially. The economy grows. Employment increases, wages rise. Everything appears healthy, but cheap money creates problems. It encourages overleveraging. Asset prices inflate beyond fundamental values. Demand for goods and services increases faster than supply can respond. Eventually, inflation emerges, not immediately. But after years of easy money policies, inflation starts rising. When inflation reaches problematic levels, central banks are forced to respond. They raise interest rates to cool the economy. The Federal Reserve raised rates from near zero in early 2022 to over 5% by mid-2023, the fastest hiking cycle in 4 decades. This tightening is necessary to control inflation, but it creates the conditions for collapse. Here's the mechanism. Higher interest rates slow economic growth, but don't immediately reduce inflation. Inflation is backward-looking. It reflects price increases that already happened. Wage growth, meanwhile, responds to current economic conditions. When the Fed tightens, companies become cautious about raising wages even as inflation remains elevated. This creates the scissor effect. Wages growing slower than prices, real purchasing power declining. This real wage decline destroys demand. Consumers can't afford to maintain spending when their purchasing power is eroding. They cut back. Businesses see weaker sales. They reduce hiring or lay off workers. The economic slowdown that the Fed intended becomes a recession, and sometimes a crisis. Before the 2008 financial crisis, the same pattern appeared. The Fed had raised rates from 1% in 2004 to 5.25% by 2006 to combat inflation. Real wage growth stagnated through 2006 and 2007. Purchasing power eroded. Combined with the housing bubble bursting, this created the perfect storm for collapse. Before the 2001 recession, real wages had stagnated from 1999 through 2001 as the Fed raised rates to cool the dot-com bubble. The erosion of purchasing power contributed to the recession that began in March 2001. The pattern is consistent. Easy money creates inflation. Inflation forces tightening. Tightening causes real wages to decline. Declining real wages destroy demand. Destroyed demand causes recession or worse. The purchasing power erosion isn't a side effect of the crisis. It's a causal mechanism that creates the crisis. The reason purchasing power destruction doesn't warn people about coming crises is lag. The erosion happens months or years before the crisis becomes visible. By the time people recognize they're in trouble, it's too late to prepare. When inflation starts rising in year 1, most workers don't worry because they're getting raises. Nominal wage growth feels good. The erosion is masked by the psychological satisfaction of seeing your paycheck increase. You don't calculate inflation-adjusted wages. You just notice the bigger number. By year 2, when inflation has been elevated for a while and real wages are clearly negative, people start feeling pressure. But they don't understand it as systematic wealth destruction. They think it's temporary. They believe inflation will come down, wages will catch up, and everything will normalize. They adjust spending slightly but don't fundamentally change their financial behavior. By year 3, when the cumulative purchasing power loss is 10% or more, people are financially stressed. Credit card debt rises as households try to maintain living standards with inadequate income. savings get depleted. But even then, people don't connect their personal financial stress to macroeconomic wealth destruction. They think it's their personal failure. Bad luck, individual problems. Only when the crisis hits, when unemployment spikes, when their neighbor loses their job, when stores start closing, when markets crash, do people realize the economy was in trouble all along. But the purchasing power erosion that created the conditions for crisis had been underway for years. They just couldn't see it. Research demonstrates this lag clearly. Total real earnings, which account for both wage growth and employment, tend to decline when inflation is high. During the 1979 inflationary episode, total real earnings losses reached almost 7%, driven entirely by erosion of real earnings via inflation. The job losses and recession came later, but the wealth destruction happened first. While purchasing power has stabilized relative to the extreme erosion of 2021-2023, the danger hasn't passed. Real wages are growing now, but they remain below 2021 levels. And new pressures are building that could trigger another wave of erosion. As of March 2025, inflation stands at 2.4%, while wage growth is 4.3%. This is positive. Real wages are growing, but this growth is rebuilding from an 11% decline. At current rates, it will take years to fully recover the purchasing power lost. Workers who feel they're finally getting ahead are actually just recovering ground they lost. Moreover, the inflation situation remains fragile. M2 money supply grew 4.6% year over year through mid-2025 and is accelerating. Historical lags between M2 growth and inflation are 9 to 24 months. If this money supply growth feeds through to inflation in late 2026 or 2027, real wage growth could turn negative again before purchasing power fully recovers from the 2021-2024 erosion. Commercial real estate problems, corporate debt refinancing pressures, and potential recession in 2026 all threaten employment. If unemployment rises, even workers whose wages keep up with inflation will see wealth destroyed through job losses. Total real earnings fall during recessions, not because wages decline, but because employment declines. Fewer people working means less total income even if individual wages stay flat. The uncomfortable reality is that the quiet wealth destruction of 2021 to 2024 may have been just the first phase. Workers who thought the worst was over because inflation came down could face another wave of purchasing power erosion if inflation reaccelerates or if recession causes job losses. And this time, households are already financially weakened from years of negative real wage growth. They have less cushion to absorb another hit. Wealth destruction before financial crises doesn't happen through dramatic events. It happens through slow, systematic erosion of purchasing power that most people don't recognize until it's too late. This is how your wealth gets destroyed while you think you're doing fine. The nominal increases in your paycheck mask the real decline in what that paycheck can buy. Over months and years, this erosion accumulates into serious wealth loss. An 11% decline in purchasing power over 3 years is equivalent to losing more than a year's wage gains. But because it happens gradually and because nominal numbers keep going up, you don't feel it as a loss. You just feel increasing financial pressure that you can't quite explain. Understanding this gives you a critical advantage. You can track real wages, not just nominal wages. You can recognize when your purchasing power is eroding, even if your paycheck is increasing. And you can adjust your behavior accordingly. Build bigger cash reserves, reduce debt, cut discretionary spending. Prepare for the crisis that inflation-adjusted metrics are predicting, even while headline numbers look fine. The quiet destruction is the most dangerous because it disarms your defenses. When wealth destruction is loud and visible, everyone reacts. When it's quiet and gradual, nobody prepares. And when the crisis finally arrives, when the purchasing power erosion reaches the breaking point and triggers broader economic collapse, those who didn't see it coming lose everything. Right now, in late 2025, the quiet destruction has paused, but hasn't reversed. Real wages are growing, but from an 11% hole. New inflation pressures are building, credit conditions are tightening, corporate debt is refinancing at higher rates. All the conditions that preceded previous crises are present. Your wealth is still being eroded, just more slowly than in 2022. And when the next phase begins, when inflation reaccelerates or recession hits, the erosion will accelerate again. By then, it will be too late to prepare. The only time to protect yourself from quiet wealth destruction is while it's still quiet. Before it becomes catastrophic, this is how wealth is destroyed before every major financial collapse. Silently, gradually, invisibly. Until suddenly, it's not invisible anymore and the damage is done. Those who understand the pattern can see it happening now. Those who don't will be asking how they ended up poor when their paychecks kept going up. The answer is simple. Their wealth was destroyed quietly and they never noticed until it was too late.